second paper entitled Portfolio Perspective on Euro Area Bank Profitability Using Stress Test Data. So we have as author, one of the authors, Orhun Mirza, Senior Financial Stability Expert at European Central Bank. Many thanks, Orhun. The floor is yours.
Hello, good afternoon. Can you see the slides and can you hear me well?
I see the slides, but Grace, now it's fine, yes. And okay, 15 minutes. Thanks.
Perfect. Thank you very much, Samuel. Thanks to all the organizers. It's a pleasure to be here today and to be able to present our work. So this is joint work with Dimitrios Mokas from the EBA, Camero Saleo and Zotrajana from the ECB, like myself. And the usual disclaimer applies. So the views that we present today are our own, of course, and do not necessarily reflect those of the institutions. And so I'm excited to present to you our work on a portfolio perspective on Euro area bank profitability using stress test data. And let me start with some motivation here. So stress tests are being conducted since quite some time now, bank stress tests, typically every 2 years for these big exercises. And they have comprehensive bank samples, very, very comprehensive data on bank risk drivers and income components. And we want to use that data for assessing profitability of Euro area banks under a stress scenario. And what we do is we take a portfolio level approach how to examine such profitability at the country and also Euro area level. And this helps us to try to answer a few questions. So importantly, we want to assess which portfolios are profitable and which are generally unprofitable, and also which ones have the highest chance of becoming unprofitable under stress and thereby may pose a risk to financial stability. Also, we look at how profitability evolves under differing adverse stress test scenarios, and notably what role the recent pandemic plays in that context. And in addition to that, we also assess the drivers that make certain portfolios unprofitable, in particular in such downturn scenarios. Very briefly, there is quite an ample literature on bank profitability, but what we do differs in the sense that we take a portfolio view of bank profitability, and also we rely on stress test data. What you see here are the key equations that we use in the aggregation of the granular stress test projections. So most notably, the first equation shows our variable of interest. That's our profitability measure that we look in. And it's a risk-adjusted return on assets at the country portfolio level. And we derive it in the following way. We calculate the effective interest rate, once again on a country portfolio level, which is the weighted average across all exposures within that country and portfolio. And from that, we subtract the weighted average cost of capital, and we subtract a cost of risk. The weighted average cost of capital is at country level, and the cost of risk is at country portfolio level. And I should say that the effective interest rate is derived from stress test data, such as the cost of risk, whereas the weighted average cost of capital, as we see in the second equation, is a weighted average between the cost of equity, and that's data that we derive from Bloomberg, so it's commercial data. And we also have the cost of funding, and that is derived from stress test data. And the weights are drawn from the leverage ratio. And the third and important equation is the cost of risk. And like I said, it's derived at the country portfolio level here. And it's a flow-based measure. So what we do is we add up gross impairment flows, namely gross impairment flows to non-performing exposures. This is, IFRS 9 jargon, let's say. So gross impairment flow 1.3, GIF 1.3 that you see here, are those exposures that move from a performing to a non-performing state and the corresponding provisioning needs. To recall, IFRS 9 has 3 stages. So exposures in stage 1 are generally performing exposures. Exposures in stage 2 are we can call them underperforming exposures in the sense of having suffered a significant increase in credit risk. And exposures in stage 3 are the defaulted ones. So we add up here the gross impairment flows of those exposures that move from stage 1 to stage 2, and from stage 1 to stage 3, and from stage 2 to stage 3. And we also account for exposures which are already defaulted, but may require some additional provisioning needs, indicated here by GIF 3.3. But there we scale the impact by the maturity to avoid an undue effect in 1 year, and take the effects of an average of the remaining maturity. And then we divide this flow by the total outstanding exposure. And importantly, we rely on the five most important asset classes in the stress test. So financial corporations, household consumer credit, household mortgages, non-financial corporations, and sovereigns. And these indeed make up the bulk of all the exposures of the banks in the stress test exercises. Let me also briefly introduce to you the data that we use. So we rely on the data from 3 stress test exercises, EU-wide exercises, the ones conducted in 2016, 2018, and 2021. Actually, the last one was postponed by 1 year due to the pandemic. And these exercises are coordinated by the European Banking Authority and conducted together with the competent authorities, notably the ECB and SSM member NCAs. And we use both banks which are in the EBA sample, but also we use data from such significant institutions that follow the stress test and are where the work is conducted within the SSM completely. And these exercises yield historical data for the years 2015, 2016, 2017, and then 2020. But most importantly, they yield the adverse scenario projections coming from the banks, so-called bottom-up projections, for key risk drivers and also relevant income and cost components. And the 3-year scenario horizons respectively are 2016 to 2018, 2018 to 2020, and 2021 to 2023. A few additional remarks before I jump into the results. So these stress tests are conducted under a common EBA methodology. So each exercise follows one methodology, and this methodology in certain respects is rather constant across the 3 exercises. However, there are a few notable differences. What is most important is the assumption of a static balance sheet, and that is there throughout the 3 exercises. And it means that banks in their scenario projections cannot assume a change in their portfolio compositions. So notably under stress, for example, they cannot assume a deleveraging. And maybe one notable change across the exercises is the introduction of IFRS 9 accounting in 2018, which meant a shift from an incurred loss to an expected loss approach, and also lifetime provisioning for stage 2 and stage 3 assets. But we abstract from that in the current analysis to make the results more comparable and more consistent. And notably, we use a consistent country and bank samples with 11 euro area countries and 61 banks that actually make up the bulk of all the exposures. So let's jump into the results. What you see here first is the historical data. So data for the years 2015, 16, 17, and 2020. There is a gap in between 17 and 2020 because there was no historical data reported in the exercises in between. We see results across the 5 portfolios of interest. And most importantly, our measure, our profitability measure of interest is the ROA, the risk-adjusted return on assets. What we see is that ROA is relatively stable between 2015 to 2017, so in the aftermath of the sovereign debt crisis. But then between 2017 and 2020, we see a strong drop in ROA across all portfolios, basically. And that, of course, is the pandemic effect, most notably in the year 2020. And importantly, for financial exposures and sovereign exposures, actually the returns are not sufficient to capture the costs. Of course, this is a bit stylized. We're not looking here into market risk or other income components or overhead costs, but only the parts that I showed to you at the outset. So on top of that, we see that the more profitable exposures are the ones to read in the retail part, so for consumer credit and mortgages, and to some degree also to non-financial corporations. But overall, one could say that profitability is relatively low, and the decrease has been driven by an increase in the cost of risk. You see the yellow bar increasing over time, but also due to a drop in the effective interest rates, as you can see from the dark blue bar, which has been declining. And one last comment on this slide, the volumes of these exposures have been relatively constant, with some increase towards the end, most notably in the sovereign exposure portfolio. Let me very briefly introduce to you the three adverse scenarios featuring those three stress test exercises. So what can be said in a nutshell is, in terms of severity on the relevant scenario variables, the 2016 and the 2018 exercise can be seen as relatively comparable. The shock to GDP at the euro area level is somewhat stronger in the 18 exercise, but then again, the impact on the unemployment rate is somewhat stronger in the 16 exercise. What you see here is cumulative growth from the starting point for GDP and a deviation in unemployment also from the starting point. At the same time, interest rates in these scenarios increase and stock prices suffer significantly, around 30%. However, if you compare that to the 2021 exercise, you see that the impact is in fact much harsher. Already on the GDP side, the impact is stronger, but you see that the unemployment rates increase dramatically more. And this is then coupled also with very low or even decreasing interest rates, which can be termed a low for long scenario. And also finally, we see that stock prices also are severely impacted. So maybe just to add that, of course, also you can imagine with the pandemic in 2020, the environment was already rather harsh, but then assuming on top of that such a crisis, I think one can easily see that the 2021 exercise is the harshest in terms of scenario impact on the banks. And that's what you see here also then in the results. So what we show to you here on this slide are the peak to trough changes in our profitability measures, risk-adjusted ROA, by portfolio under the three adverse scenarios. So we take the, let's say, lowest ROA projection across the scenario and subtract the starting point here. And what we see across all portfolios and all exercises is that ROA drops. This is not surprising, as we assume a crisis scenario. However, we see as well that the impact is clearly the strongest for the 2021 exercise, with the sole exception of sovereign exposures, but that's because the methodology is very prescriptive on sovereign. So looking more at the other portfolios, the impacts are notably the strongest in the higher risk portfolios, and particularly consumer credit and NFC exposures. And the results are driven notably by a strong increase in the cost of risk, and also to some degree by a drop in effective interest rates. I want to convey one more message here on the results before I conclude. So what you see here is a scatter plot the scatter plot shows country portfolio profitability. So each dot represents a country portfolio pair. And the x-axis plots the ROA at the starting point of the exercise, in this case the 2016 exercise, and the y-axis shows the worst ROA in the adverse scenario. And what we see here is that all of these dots are either on the 45-degree line or below, meaning that the scenario actually has a negative impact on the ROA, but still the bulk of these dots are in the upper right quadrant, meaning those scenarios are largely profitable before and after the shock. A similar outcome can be seen for the 2018 exercise, as you can see here. But if we look at 2021, we see that actually now the scatter plot looks quite different, actually with two main effects. The dots move to the left, which means that already at the starting point, scenarios are much less profitable, yeah, with the pandemic outbreak. But also we see the drop to the bottom, meaning that these country portfolio pairs are even less profitable under stress, are even more severely impacted by the adverse scenario. And what we see is that really the bulk of all country portfolio pairs are below zero, meaning non-profitable under stress. And a significant share, almost half of them, are in the lower right quadrant, meaning they have switched from being profitable to becoming loss-making under our setup and assumptions. And I'm not going to repeat what I said before, but just for your awareness, there's some ongoing work from our side on this, and we are still assessing the difference of using marginal instead of average cost of funding to assess the impact rather on new business. Also, we look into the effect of switching towards an IFRS 9 expected loss approach. And finally, we are starting to conduct some regression analysis, in particular on how the probability of portfolio switches is driven by the relevant profitability components, but also macro financial drivers and other structural indicators. Thanks a lot.
Many thanks, Søren. Now, as discussed, we have Inês Drummond, Deputy Head of the Financial Stability Department at Bank of Portugal, and also researcher in Research Center in Economics and Finance at the University of Porto. Inês, the floor is yours. Many thanks.
Thank you very much.
In 9 minutes.
9 minutes, okay. Let me know if you are just hearing me and
yes, very well.
Seeing my slides as well. Yeah?
Yes, perfect.
Okay, thanks a lot. And thanks a lot for having invited me for this workshop, and in particular for this session and this paper, which I think is very interesting and very important in the current juncture. So basically my presentation is very short. It's divided in two parts. The first one actually summarizes the main features and conclusions of the paper, and the second raises some questions and comments. So starting with the main features and conclusions of the paper. So the paper assesses Eurobank profitability using granular data coming from stress tests conducted by stress test exercises conducted by the EBA. So it's a very nice feature of the model using this microdata to assess banks' profitability using the 3 exercises. And as mentioned before, the authors develop a measure of profitability built on a portfolio level risk-adjusted ROA, and both for the euro area and also for individual countries, which is also very useful because then they can assess not only heterogeneity across segments, but also heterogeneity across countries. And so they use these measures basically to assess to what extent adverse macro and financial developments affect profitability of banks, and in particular the profitability of specific bank activities and portfolios. So the methodology is basically focused on what the authors mentioned as the 5 main portfolios of banks, so financials, consumer credit, mortgages, non-financial corporations, and sovereigns. And the measure that was developed considers interest on assets, weighted average cost of capital that includes both cost of funding and cost of equity, and the cost of risk. And the authors explicitly abstract from any impact on market risk consideration or overhead costs. And then the measure is basically used for 2 main purposes, probably 3, I would say. So the first is based on historical data, assess the profitability of each portfolio over time. And then based on banks' projections, assess how macroeconomic conditions may affect the profitability of each asset class under analysis. In addition to that, they, as I mentioned before, they also assess heterogeneity across countries. and also the portfolio transition. So basically the transition from profitable to unprofitable status. So I would say that the main, So the main results are the following. So basically both the retail portfolios and also NFCs are those that have the highest returns. And sovereigns, in contrast, have consistently zero or even negative returns. A scenario of a severe recession coupled with low for longer interest rates, so basically the one that was underlying the 2021 stress test exercise, yields a significant drop in profitability in all portfolios except for sovereigns, which actually are more affected in a stress test like the 2018, where actually a strong increase in interest rates with a relatively higher impact on funding costs than on returns. Then on heterogeneity, the authors find that actually the metric increases under the adverse scenarios, and that this increase is more significant for the 2021 exercise. While regarding portfolio transitions, they also see an increased impact from the stress test from 2016 until 2021. And finally, which I think is also an important conclusion, the authors found that actually the negative portfolio profitability, or the switch into negative portfolio profitability, is more pronounced for portfolios that already record low but non-negative profitability. Okay, so what are my main comments and questions? So the first two are related to the way the authors compute the weighted average cost of capital. So as I mentioned before, basically it's divided in the cost of funding and the cost of equity. And actually the first two questions apply both to the exercise that focuses on observed data, but also on banks' projections. So starting with the cost of funding, if I understood well, there is some kind of heterogeneity that is introduced at the portfolio level, but this is basically due to the weights that are being used, because I think the main assumption of the paper is that the cost of funding is assumed to be the same for all asset classes for a given bank. So my question is, if actually you are not missing with this approach some kind of variation in the cost of funding based on loans maturity or even on cash flow dates or repricing dates. Because basically by assuming that the cost of funding is the same for all portfolios, you are basically assuming that the cost of funding of a loan with a maturity, for instance, of 5 years is the same of a cost of funding of a loan with a maturity of 3 months. So if you assume actually that the yield curve has a positive slope, then you can be overestimating, right? So overestimating the cost of funding for the short-term financing and underestimating the cost of funding for the more long-term exposures or long-term financing. The second question is related to the cost of equity. So I think that the same assumption is followed here. So you assume that the cost of equity is the same for all portfolios of a given bank. And so my question here is if you are also taking into account to some extent the different risk weights that are associated to each exposure, because they are very different as well. So I think that the first thing that crosses my mind is the sovereign. So the risk weights on sovereigns are lower to some extent. Some of them are zero. So to what extent you are considering this, and if you are not, if this could actually change the results, notably when assessing the profitability of sovereigns and other portfolios. Thirdly, and this third question now focuses only on the part regarding the projections by banks, is to what extent the constraints considering the EBA stress test exercise are influencing the main conclusions of this study. And here, basically, you have two main constraints that you mentioned in the paper. One is the static balance sheet approach, which I think actually works nicely in your paper because you want to actually assess the profitability of each segment. But you also take in consideration the caps and floors for interest rate margins. And this might be a quite strong assumption when you want to assess the profitability of each portfolio, right? Because they are using caps and floors both for interest earnings and interest-bearing liabilities. And this might be quite strong because in reality, banks have more flexibility in setting interest rates than what is considered in the exercise. Now, two broader questions. One is regarding one of the conclusions of the paper, according to which exposures with already low profitability at the start of the projections could be those with the largest deterioration of their profitability. And my question is to what extent actually this result challenges the idea that we have that actually the more profitable assets tend to be also the more volatile one and the riskiest one. Because actually what you find is that those that were already with a low profitability are those that also face a more significant decrease in profitability. And secondly, and to some extent related with these conclusions, but also with other conclusions that you draw from your paper, and probably this is part of the work in progress that is still being done, is that I think that to some extent some further analytical work may be needed, because sometimes it's even difficult to check the conclusions that you draw from the charts that you have in your paper. So some kind of robustness checks regarding the correlations that you found could be also nice to introduce in the paper. Finally, some very short clarification questions for clarification. So regarding the cost of risk, and you mentioned that in your presentation, so you basically take into account the transition from stage 1 to stage 3, from stage 2 to stage 3, and also the impairment flows associated to stage 3 exposures, and I think it's rightly so. So I agree with this approach. My question is why the latter should be scaled? So why should you scale the impairment flows associated to stage 3 exposures? And if you need to do that, why do you consider the remaining maturity? And finally, at some point, the paper mentions that it is unlikely that on aggregate, banks shift the allocation of their assets away from the portfolio that will be most affected by adverse scenarios. Is this conclusion basically based on the fact that actually there are some kind of substituting effects between banks when you assess this kind of effect on an aggregate basis? Because I would think that on an individual basis, the banks actually may shift, may have this kind of reaction when faced with adverse scenarios, but probably on aggregate, due to these substituting effects, you may have this kind of conclusions, just for clarification. And finally, I think that in the paper, it would be interesting to have more details on how we compute the cost of equity and cost of funding, because it's not very clear how the weights are computed and what is the impact of the weights being used. So thank you.
Many thanks, Ines, for the great questions. I will invite the audience to also to provide some questions via chat. In the meantime, Arun, do you want to address these topics?
Yes, certainly. So many thanks, Ines. Very, comprehensive, very thorough comments and questions. Extremely helpful. So thanks a lot. And indeed, as you mentioned, we're still working on some parts, and in particular on the robustness side, that's something we're still looking into. So very well taken. Let me start to address a few of the points that you have raised. So you mentioned the heterogeneity in cost of funding, and you're absolutely right that in principle, we are assuming a constant cost of funding at the country level. The variation that we see in the data after aggregation across portfolios, which is very minor, by the way, comes indeed, like you say, from the different weights of the individual banks within that. So one bank may have large exposures to sovereigns, and one may have large exposures to financials, for example. And if we then weight or create a weighted average of the cost of funding across the banks within a certain portfolio class, you can get some variations across portfolios. But in a sense, that's not the main driver, and it's rather contained. You're right that currently, indeed, it's a very kind of a simplifying assumption, the way we do it. It's also because we don't have different, we cannot easily associate cost of funding with the individual portfolios, but I like very much your point on asking how the cost of funding may differ across maturities. And indeed, we do have some data on the maturities. So I think that's probably a good takeaway for us, that we can assess whether, let's say, in line with intuition, one could expect a higher cost of funding for longer maturities. And that may, provide, more nuanced cost of funding. And we could then, for example, try to associate these higher cost of funding for longer maturities with also longer maturities on the asset side. So I find that a very helpful remark. Thanks a lot. Then you mentioned different risk weights and how the cost of capital, cost of equity may differ. Once again, well taken, and indeed so far a simplification, because we have been focusing more on the interest rates and the cost of risk, but indeed a more refined approach or view towards how cost of equity affects the individual portfolios could be helpful. So currently, indeed, it's a simplifying assumption to keep it constant. And I think still we have a useful, comprehensive picture. But indeed, I think it could be helpful to see whether there are ways to make this a bit more refined. For example, like you say, informing this with the relevant risk weights, which obviously differ dramatically between, as you said, on the extremes, for example, sovereigns versus consumer credit or so. So that's also a helpful point. You mentioned the static balance sheet assumption. I agree that, or I think very much that it's a helpful assumption for us, because we don't want to assess how profitability is affected by bank behavior, but we actually want to see what is the impact of the scenario on bank profitability, and kind of forcing banks not to change their business model across the scenario horizon means we can very clearly assess the impact of these scenario variables on the profitability of the respective portfolios. Then you asked why we scale this GIF 3.3. We scale this change in the provisioning for the defaulted assets. That's just to safeguard it against kind of a possible cliff effect where in 1 year, let's say default exposures have been under provisioned, and then in 1 year a new provision is needed. But these may be like really large legacy assets in some cases, and we're not so much interested in these legacy effects, but rather want to see which business is profitable as such and which is less profitable. So we think it's it's more nuanced if we spread it over the remaining maturity and do not look too much, or are not too much affected by these kind of legacy asset effects that may occur. But in any case, this maturity scaling should not have too much of an effect. I think what will matter more going forward is the expected loss approach, because there are some portfolios where lifetime losses may be higher than 1 year losses. So indeed, that's something we're investigating at the very moment. And then you asked about how banks may shift away their exposures from one asset class to the other. Of course, I mean, this takes time, with depending on the maturity, so they cannot necessarily easily shift business from one to the other. Also, some of the business may be held, or some of the assets may be held, for example, for liquidity purposes. So it would not necessarily be straightforward to shift assets away from such portfolios. And a final point, you raised the question how we come to the conclusion that the less profitable portfolios, may be more prone to switching. I think at least in some cases, maybe just that some of these are already so close to being, non-profitable that like only already a minor tick already pushes them over the edge. And that's, I think, the effect here. But overall, we see indeed that the higher risk portfolios also see the strongest increase in cost of risk. And that's what you see when we look at this peak to trough effect. And we see for consumer credit, non-financial corporations, to some degree also mortgages, that the cost of risk, this yellow bar, really increases a lot. Thanks very much for the nice discussion earlier.
Thank you all for the presentation and discussion, excellent discussions. Now